Hey everyone, welcome back to Corporate Decoder. Today, Inuvo Incorporated just filed a Form 8K, and I am seeing some really interesting financial maneuvers that tell a story. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company just raised a significant chunk of money through a stock and warrant offering, and they also took on new debt, all while paying off old debts. Let's dive in. This report is all about big financial moves happening at Inuvo Incorporated. They've made some serious decisions about their money and how they are going to fund their operations moving forward. The first major event is a securities purchase agreement that Inuvo entered into on the 30th of June 2026. Essentially, they agreed to sell a bunch of their common stock and some special warrants to an investor. This is a way to bring in cash. They sold over 1.6 million shares of common stock at $1 per S-share. They also offered something called pre-funded warrants. Think of these as a way to buy stock later at a set price, but you get them now. They sold almost 1.4 million of these at $0.999 each. These shares and warrants were sold using a shelf registration statement, which means they had some stock already registered and ready to be sold. This made the process quicker. The whole deal is expected to bring in about $2.97 million before fees. This is a common strategy for companies needing quick capital, but that is not all. On top of selling stock and pre-funded warrants directly, they also agreed to sell two types of common stock purchase warrants in a private placement. These are Class A and Class B warrants. They are giving the investor the right to buy roughly 3 million shares in total with these warrants. These warrants have an exercise price of $1.28, and they will become exercisable 6 months after they are issued. The Class A warrants expire in 5 years, and the Class B warrants expire in 1 year. This means the investor can buy more stock at a higher price later on, which is how the company can potentially raise even more money down the line if the stock price goes up. To help make all of this happen, Inuvo hired Ladenburg Thalmann and Company Inc. As their placement agent, they got paid a fee of 6% of all the money raised in these offerings. On top of that, Inuvo also issued warrants to the placement agent itself. These are warrants to buy about 5% of the shares sold in the offering. This is a pretty standard practice to incentivize the agents. Now, on a different note, Inuvo Incorporated, a subsidiary of Inuvo, extended an agreement with Google LLC. This agreement was originally set to expire soon, but they've added 3 more months to it, pushing the new expiration date to the 31st of July 2026. This is likely for cloud services or advertising platforms that Inuvo uses. It's not a huge deal in terms of financing, but it shows continuity in their operational partnerships. This section is brief. It seems to indicate that there might be some termination of a material definitive agreement, but the details are incorporated by reference into another item. This is where things get really interesting financially. On the 29th of June 2026, just before the stock offering, Inuvo entered into a note purchase agreement with Streeterville Capital LLC. This sounds like a loan. They issued 2 secured promissory notes. The first is for $4.142 million called the A-1 note, and it has a 9.0% interest rate with an original issue discount of $342,000. An original issue discount means that the actual cash received is less than the face value of the note, which effectively increases the interest rate. The second note is for $6.2 million, the B note with a lower 5% interest rate and no original issue discount. So in total they received about $10 million from these notes, but here is the crucial part of how this money was used. A large portion, $6.2 million, was put into an account at Lakeside Bank, held by a newly formed subsidiary called INUV Holdings LLC. This money is held under a deposit account control agreement, which means Streeterville Capital has control over it as security for the loans. The remaining $3.8 million from the A-1 note was used to pay off existing convertible promissory notes, including about $2.8 million in accrued interest. This is a really significant move. They are replacing short-term, potentially dilutive convertible debt with longer-term secured notes. This is a move to clean up their balance sheet and reduce immediate pressure from these old notes. They also repaid and terminated a receivables-based credit facility. This means they have no outstanding convertible debt and no amounts owed under that old credit line right now. The structure of the B note is also quite interesting. The company has the right to exchange portions of the B note for new A-1 notes. For every $2 million reduction in the A notes, they can exchange $1 million of the B note. This allows them to potentially convert the lower interest B note debt into the higher interest A-1 notes under certain conditions, which might be beneficial if they can manage their cash flow well. The money released from the deposit account after such an exchange goes to the company's operating account. Interestingly, Ladenburg Thalmann and Company Inc. was also the placement agent for this note purchase deal. They earned another 6% fee on the gross proceeds from the A-1 note and a 6% fee on any cash released from the B note deposit account. So the placement agent was involved in both the equity and debt financing. Let's look at the repayment terms for these notes. The A-1 note principal is due in 24 months, meaning 2 years from the issuance date. Interest accrues at 9.00% per year. The company can prepay this note without any penalty. The lender, Streeterville Capital, also has some redemption rights, starting 9 months after closing. They can redeem up to $750,000 per month. They also have limited redemption rights if the stock trades at a price that is at least 10% higher than the NICE minimum price. This is a way for the lender to potentially get their money back sooner or benefit if the stock performs well. The B note also has a 24-month maturity date. The interest rate is 5.00% per year, and it can also be prepaid without penalty. While it doesn't have the monthly redemption feature of the A-1 note, it does have limited redemption rights and the note exchange. Right, we talked about, both notes have clauses for major trigger events and minor trigger events. If these events happen, the lender can increase the outstanding balance of the notes by 10% for major events and 5% for minor events. If the company can't fix these trigger events after a notice, it becomes an event of default, which could lead to the acceleration of the entire debt and a default interest rate. These are serious risks that the company and investors need to watch closely. This section talks about the unregistered sales of equity securities. It confirms that the common warrants and placement agent warrants mentioned earlier are being issued under an exemption from registration, specifically Section 4 and Rule 506 of the Securities Act, which means they are sold to accredited investors and are not part of a public offering. The shares issuable from these warrants have also not been registered yet. On the 30th of June 2026, Inuvo also issued a press release announcing the pricing of the offerings described. This is standard practice to inform the public about these significant financial events. The press release likely highlights the successful fundraising and the benefits of the new debt structure. Finally, the report is signed by Wallace Ruiz, the Chief Financial Officer. This signifies the company's official acceptance and filing of these important financial actions. Now, let's put all of this together. Inuvo is clearly in a situation where they need capital and are restructuring their debt. They've brought in new money through a stock and warrant sale, which dilutes existing shareholders but provides needed cash. Simultaneously, they've taken on new debt in the form of secured promissory notes. The key here is that they use some of the new debt proceeds to pay off older, more problematic convertible debt. This is a positive step towards financial stability, moving away from potentially dilutive instruments and towards more defined repayment schedules. However, there are significant risks. The new debt is secured by the company's assets, and there are trigger events that could increase the debt burden or lead to default. The warrants, both for the investors and the placement agent, represent future dilution. The market capitalization of Inuvo is quite small, around $18 million, and they have only 64 employees. This indicates they are a microcap company, which inherently carries higher risk. Compared to a similar situation when a company like Bed Bath & Beyond was trying to raise capital and restructure its debt in its later stages, they also engaged in dilutive financings and debt maneuvers. While Inuvo is not in bankruptcy like Bed Bath & Beyond was, the strategy of issuing new debt and equity to manage existing liabilities is a common path. Often for microcap companies, these types of financings can be a sign of distress rather than a simple capital raise, approximately half of micro. Cap companies that engage in significant reverse splits or dilutive equity offerings eventually face delisting. While this isn't a reverse split, the dilution and increased debt load are factors to watch. My biggest concern is the reliance on secured debt and the potential for trigger events to worsen their financial situation. They've essentially refinanced their debt, but the underlying business needs to generate enough cash flow to service this new debt and eventually repay it. The fact that the lender has control over a significant portion of the new loan proceeds is also a point to monitor closely. The risk I am watching is whether this new capital infusion and debt restructuring will be enough to turn the business around, or if it is just kicking the can down the road. The success of the warrant exercises in the future hinges on the stock price increasing, which depends on the company's operational performance. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this breakdown helpful, please like this video and subscribe for more. Join our Discord in the description for more discussions.